Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right. Hello, Andy. How you doing today?
Doing good.
Welcome to Flight 125, the Pilot Money Guys. Thanks for being with me here on another episode of the Pilot Money Guys, where, Andy, our mission is to deliver actionable ideas, simplify the complex, and cut through the financial noise so that everyone we're talking to can build a mindset for financial and life success. So that's our goal, it's our mission. So today we've got our work cut out for us because we have a lot of stuff to cover. But I know. So the biggest, you and I get excited. We were talking about it before the show, like all this information. To me, this is one of my favorite topics. And what that is going to be is called Mind the Gap. It's a Mind the Gap study that Morningstar does every single year and talks about the return that we all should be getting. Andy, can you amplify that a little bit more just for introductory purposes?
Yes. It's the return, like just you said, return you should be getting, right? Which is if you just bought and held a fund, ETF, or a mutual fund versus what do investors actually get? And that gap is essentially like a behavioral gap.
Absolutely.
So it's pretty fascinating, some of the reasons behind that. And I think it'll be helpful for our listeners.
It is. I think so too. I think to me, this is my most favorite topic, first of all, because it's fascinating. We all have these biases that really serve us well in most parts of our lives, but sometimes in the stock market, they don't. We're going to talk about those. So today, we're going to describe this study, the Mind the Gap study from Morningstar. We're going to talk about why this happens, why you should care, and what you can do about it. So we'll go into more detail in that, very shortly. But first, we got a few questions from the flight deck that we want to address. A lot of stuff going on current event-wise. Andy, we've got the Trump accounts. You're going to talk to us about that. We've got tax season. So people are already starting to either get refunds or they probably haven't got refunds yet. Maybe that'd be quick. But they have been told they might get a refund or they've been told they owe some money. What can you do? What are some things to think about? And we might even touch on the recent Southwest, I don't want to say drama, but situation.
The saga of Roth catch-up.
Or there could be a little surprise Easter egg for you come, summertime where your 401k is now withholding double of what you thought it might. So we'll talk to that as well in a minute. All right, Andy, first, and you can pick any of those, a plethora of questions from the flight deck, but maybe the Trump account. What do you think?
Yeah. I think it's relevant to talk about now because folks, as they file their tax return, can actually elect to open the Trump account, Form 4547. That's not a coincidental number, right, for how that was chosen. So a couple of things to think about. I think there'll be articles. There's a lot to talk about here, but just at a high level, like, should you participate? Should you contribute? I think right off the bat, if you were to think about a Trump account, if you have a kid who was born January 1st, 2025 through December 31st, 2028, we'll put $1,000, they being the government, will put $1,000 into your Trump account.
Nice. Andy, I'm going to interrupt you for a minute because I'm going to repeat that. January 1st, 2025 through December 31st, 2028. If your child was born there, you got $1,000, free dollar, no income limits, nothing like that.
That's it. I know. You're thinking about having another kid now, aren't you?
Yes, I think so. I think we could, maybe.
Yeah. So I think
totally worth it.
Totally worth it. I think the upshot for folks is you should do it, right? It's a free $1,000. So, the name can be polarizing. Some people will do it no matter what. And some people will say, I'm not going to do it. But you just think about it like it's a free $1,000. You should take that money and invest it. So highly recommend looking into that if you fall into that category. And then any kid under 18 can participate. These will start being available July 5th. Also not a coincidence, 2026. Any kid under 18 can participate in the Trump account, meaning you can put up to $5,000 on behalf of your kid. It's not tax deductible. And then I think the discussion probably gets a little bit more nuanced. And like I said, we could probably have a whole podcast on how to think about funding just for your kids, because
Yeah.
now you've got competing priorities. Once we're done talking about you get a free $1,000, you should always take a free $1,000.
Yeah.
No strings attached. But now we're talking about competing savings priorities of 529s, UTMA
Yeah.
accounts, Trump accounts. And I think that the discussion gets a little bit more nuanced on is the Trump account really the best vehicle to achieve the goal you're trying to achieve through savings. I think the best way to think about it, Charlie, is think of it like an after-tax IRA. So
Mhm.
right, you're not going to get a tax deduction when the money comes out. You'll owe ordinary income to the extent that you have earnings. So you kind of becomes like an IRA, and your kid will have access to it at age 18. So just
Mhm.
there's some pitfalls there, I think, that are
Yeah.
that are worthy of considering.
Absolutely. I'll add one little nugget that I think kind of resonated with me, and we don't need to go into much more. We could go on the pro rata rule. I know that would be exciting
Yeah.
to our listeners, and they would
Oh,
turn it off.
totally.
But
Yeah.
I think the thing that each one of these accounts you mentioned, 529, UTMA, custodial Roth, has its
Yeah.
little strings attached. And for me, I love, love, love the custodial Roth for young people. However, you need to, I was going to say you kind of, but the IRS says you need to be able to justify income for your child.
Yeah.
Now, a child of 3 or 4 years old, your son could be in a commercial and make money and could do custodial Roth. That's not illegal.
It's a good idea.
So it happens, but it is kind of sometimes hard to, people don't want to mess with that.
Yeah.
So this could be an alternative. And that's one of the things I think about
Yeah.
ways to save for your kid.
That's right.
You
Yeah.
don't have to have that. You don't have to have proof of the earned income, I should say.
There you go. Yeah, great point. So a lot to think about. I mean, it's exciting. I think anytime
Yeah.
there's new, but you're right. There's going to be nuance either way. But yeah, it's good stuff.
Excellent. Excellent. I think real quick, Andy, I'll touch on just for our Southwest folks that are listening. There looks like there's a little bit of technical glitch. I know Southwest folks are like, oh, again, technical. But anyway, hopefully it gets resolved. But
Yeah.
for those of you that are maxing out your 24,500 bucket, your 401k, 24,500, that's also known as a 402G bucket. For those of you that are maxing that out soon and then will be transitioning to the Roth catch up, watch out. There could be a situation where if you have a 12% 401k contribution setting and a 12% 401k Roth catch up setting, that may be additive in that month that you max out 24,500. So in other words, instead of 12% coming out, it could be 24% coming out in that particular month. I know we put out a video on this. Check it out on YouTube, our YouTube page, Leading Edge Financial Planning YouTube page. It can be confusing. I just want to get it out there as a public service announcement. Every other airline, ignore that because it may even add to your confusion. But I
Yeah.
think it's worth saying it just to go, hey, look into this and figure out when that month is that you're going to max out the 24,500 because that's the month it may happen.
Yeah.
All right, Andy, did I confuse or is that worth the announcement?
Worth the announcement for sure. Because you just don't want to get, if you're a Southwest pilot, that could be a cash flow problem. So I know in the video you talked about a couple of options, right? One is just accept that it may happen. You could turn it off. The nice thing about catch up is you're not competing against anything else to get that. So sooner is always better, I think, when it comes to saving for retirement. But you could turn that off, kind of let the 24/5 happen, and then go in and turn on. You just have to remember to turn it on, and that's the risk. Is you turn it off, and then it's December, and you're like, oh no,
I
didn't do my catch up this year.
Absolutely. Yeah, that's a
The horror.
Southwest thing only because it's
Yeah.
you've got to fill up that 24,500 402G bucket. You've got to fill it up before you can have any catch up going in there. Again, Southwest only, other airlines are going on simultaneously or concurrently. So again, Southwest folks, use caution for that. All right, Andy, it's tax season. And we're starting to see people, again, like we mentioned earlier, hey, I'm getting a refund. I'm getting a huge refund. I owe a huge amount. I mean, what are some options for people to think about here in these circumstances?
Yeah, I think if you fall into you get a huge refund, some people kind of like it. Some people are like, yeah, I just gave the government a interest-free loan for a period of time. So I think if you fall into that, like a significant refund, check your withholdings. You might be over withholding. Things that come to mind would be like if you're doing itemized deductions, right? You can actually account for that in your withholding because you're going to get more than the standard deduction, means you'll pay less in taxes. Did you have some kids along the way and you haven't updated that child tax credit? So I think those are things that kind of come to mind for me about just take a look at what your withholdings are. Or if you had a filing status change, right? That's maybe you got married and now you're a married filing joint. You were single previously. Those W-4s that they don't track you. They don't stalk you, right? So you've got to
thankfully.
Exactly. Yet. That's right. Yet. So you've got to remember to go in there and update those when life changes happen along the way.
Yeah, absolutely. You mentioned a couple, I think, before in our prep, like kids age out, or your income exceeds thresholds where you lose significant either tax credit or tax deductions. Like you said, getting married or getting divorced could be a surprise in a lot of different ways than just a tax refund, right? But those big life changes, income can all of a sudden exceed certain levels, and then bam, it kind of have a cascading effect. And surprise you a little bit there too. So
totally
watch out for those.
Yeah, I guess that's the flip side. Now you owe.
Mm-hmm.
If it's a little bit, that's not bad. You're kind of right on. If it's a lot, that's kind of a bummer.
Yeah, I think I would personally. Everybody has a personal opinion on this, Andy, and some people love the fact that they get a big refund. It's like the forced savings component. There is a cost to that depending on interest rates. But man, I don't like waiting on a refund. That kind of just my personal one. Like, I think I'd rather pay a little bit and just, I don't know. Surprises can be painful though.
Yeah, absolutely. Yeah. I don't want to, it's no good.
You don't want to pay any, you said?
Yeah. I'm done in this tax
You want
thing.
a lifetime exemption. Yeah.
That's right.
Sounds good.
You could do that. You just don't work.
Yeah, that's right. You stop making money or you risk jail time, maybe. I don't know if it's
that's
worth
right.
it.
Yeah. There you go.
Anyway, lots of good options. We tell people all the time, it's a voluntary tax system. You can put on there whatever you want. I mean, just be ready for the consequences. That's right. So anyway, all right, Andy. Well, very cool, man. Thanks for going through that. Questions from the flight deck. Let's jump into our mission today. Mind the Gap study from Morningstar. We're going to cover what this study is a little bit more in detail. Why does this happen? Why you should absolutely care, and it will. How do I say this without sounding over the top, Andy? But it can make you money. I mean, there is a major cost to not at least knowing and understanding your own behavioral biases. We all have them. You and I have them. We just happen to be a little bit more aware of them, and we can kind of work around them. And I think that's a huge part of it, just the awareness. And so that's what we're going to talk about today. I love this topic.
Yeah, and we love Mind the Gap. We love it so much, Charlie. We actually have it in our investment policy statement for our clients. We have a section or a cutout that sort of emphasizes all the things we're going to talk about today, because it's important, right? When we talk about how we're going to invest our clients' portfolios, that we're aware of these biases.
Absolutely. I'm going to jump the gun a little bit, Andy. I'm getting just too excited about it all. But these things, these cognitive biases that we have, and I mentioned it in the intro a little bit, they're innate in all of us. They help us survive car accidents and react quickly, think quickly. They're basically heuristics or shortcuts for our brains, so that your brain can kind of go on autopilot and just relax and get you to work without thinking too much. But in the world of investing, it really does work against us most of the time. And so that's an odd mix, right? So we really have to understand and be very cautious. A lot of our people, a lot of our clients, a lot of people we talk to, they are very aware. They'll call us up and go, "Hey, look, I know this about myself." And to me, my hat's off immediately, because that is a sign of a great investor that says, "Hey, I'm humble enough to understand my own limitations, my own biases." And that's it's pretty fascinating. But Andy, okay, I'm done with my rant. What is the study? Can you give us a little more detail?
High level. So they look at mutual funds, ETFs, and they do it over a 10-year period. And they say over the last 10 years, if you had just bought it on, 10 years ago, bought a fund, and just held it, didn't do anything. So that would be more of like a time weighted return. You reinvested the dividends, didn't buy or sell, just put a lump sum in. What would your return have been? Right. And then they say, okay, they look at fund flows. In other words, that's a proxy for investor buying and selling maybe at inopportune times, right? Buying more when the market is up, selling when the market is down. And that's what we call a dollar weighted return, or like internal rate of return. And so the difference between the two, and they look over the last 10 years, it was about 1.2% annualized, right? Which is actually fairly significant, across all funds. The difference between the two, they say, is the gap, right? So hence the name Mind the Gap, right? And so that's, there are certain things that are happening there that it's an imperfect science, right? It's not to say this is only because of poor investor behavior and behavioral biases, right? There's so much at play here, and we'll talk a little bit about that. But in general, it does make you think, and the paper does a nice job of making you kind of think through, like, why would that happen, and why do we have this 1.2% annualized gap? And that's been persistent, like Charlie, like you said, they do that every year, right? So this gap, it changes a little bit, but it sort of is always present. And so it's just kind of interesting to think through some of the reasons why, and I know we're going to dive into those, kind of what those are, and where the gaps smaller and larger, right? Because when we say 1.2, that's across all funds, but of course, there's a lot of different funds out there, a lot of different investment styles out there, and
Absolutely.
they're not all the same.
I think that's going to be huge for people to hang on to and listen to. You're going to talk about what different styles of investing, I think I said that correctly, where these gaps widen significantly. So, and let me rephrase what you said a little bit. Basically, investors, what Morningstar is finding is that investors are not getting the return. Let's say it's a mutual fund. They're not getting the return of the mutual fund itself. So like you talked about time-weighted return. Let's say January 1 to December 31st. If you go look up this mutual fund or ETF rate of return, let's say it's 10%. Well, then that's what the fund got, 10%. And if you invested, all your dollars January 1 and didn't touch anything, you'd get that return. But the dollar weighted return is we invest, let's say, like you said, not an emotional thing, but I'm just have to dollar cost average. At December 31st, I'm going to have probably a different return than the 10%. And so especially if I made an emotional sell or two here and there, on average, I'm not getting the 10% that the mutual fund got. I'm getting 8.8. And people go, wait a second, I didn't get the same return. These are some of the reasons why. Right. So hopefully I restated what you said.
No, it's perfect. Last year is even a great example, right? S&P 500, like to your point, you bought on January 1st, 2025, S&P 500 index fund, you got about 18%. But, April last year, the tariff meltdown, that was an emotional time. We didn't really know what the markets were going to do. So if you had maybe sold at the bottom, right, after it had gone down, then of course it bounced up quickly and you rebought the same fund. Well, you were not going to get 18%. You're going to have a return that's much lower. And so that's sort of the genesis of this discussion. And again, there's lots of reasons why you have the gap, but the high level overview and some of the discussion points I think are relevant, regardless of if you can say, well, actually 0.2% of this should be because of this. And those are valid. Those are valid points. But
absolutely. Yeah. Again, back to the mantra, know thyself as an investor. Some will be less affected by this than others. But Andy, we talked about the cognitive biases. We'll get back there a little bit, but in general, can you tell us a couple of these categories? I think active versus passive. Volatility plays cheap or low expense versus high expense. What about those? Where does this gap widen or narrow, if at all?
Yeah, I think when we look at the gap, the biggest gap would be sector equity funds. In other words, I'm going to go buy utility or technology or communications, right? Think about the 11 sectors of the S&P 500. So that gap was about 1.5% ending December 31st, 2024. So the 10 years ending. So that would be where we have the most sort of, I'd say, maybe behavioral or trading that's different than what you would get if you had just bought it and held it for 10 years. And then you compare that to where did we have the lowest gap? One of them would be asset allocation funds. Well, the most popular asset allocation funds out there are what's called target date funds. I think most people are familiar with that.
Mm-hmm.
That's usually they're in your 401k as a default investment option. And so you say, I'm going to retire in 2065, and you can buy the 2065 target date fund, and it changes your asset allocation. And I think there's a lot to talk about when you have that disparity. It was 0.1%, right? So when you got 1.4% disparity over 10 years between those two, that to me is pretty interesting about why why we would have that. I don't know. What do you think, Charlie?
Yeah, that is interesting, and I'm fascinated by the sector ones. Because I used to do, like, I remember as an early investor back in the 2000s, I was like, oh, healthcare is all the rage. Now Vanguard's healthcare fund, you got to get in that. And then I was like, oh, I got to be in an energy fund, and clearly that is like a veiled way of timing the market and making speculative guesses about which sector is going to do well when. But you feel like it's not, because it's a fund, right? And you feel like, oh yeah, this is just what I'm supposed to do. But
it's an index fund.
I know it's an index, so it's got to be.
I can't be active if I'm buying it.
Yeah, so I did that for years, where I'm like, oh, this healthcare is great, and then until it wasn't great, and then it was like terrible for a long time. And then same with energy. Like, energy's awesome in 2000, and then it was like another 10 years of nothing. And so that's that gap where you can get just destroyed. And I use that word destroyed, that's maybe a little bit hyperbole there, but nonetheless, it can happen. We've seen it. And I think it's something to take very seriously. So.
Yeah, I think you're right. I think that those sector funds, that's where you're going to be, people are more active, right? You're taking active bets on, just like you said, Charlie, healthcare, energy, real estate. That's where I want to be to get the highest return. I read an article. Yeah,
absolutely. This is what's going to happen in the next several years. So I'm getting the energy fund.
I'm going to get it.
Total. Well, and again, I like to differentiate too between speculation and investing. And people go, hey, I'm going to do this thing. I'm going to buy this stock, whatever. And I go, that's great. We get it. But just understand what speculation is versus investing.
Absolutely.
Each of them has pros and cons. I don't personally believe your 401k is for speculating, but maybe there is an account that is better suited for that, and just understand that. And I think that's the most important thing. Know what you're getting into there.
And I think conversely, you talk about those allocation funds, those target date funds. That's where you're who's more likely to be in those. It's probably your set it and forget it investor, right? If you're an investor and you're like, I don't know what to do, I'll just put it in the target. I'll put it in the target date fund. And where the majority of I think most investors' assets are in those qualified 401k type plans, you really don't have sector ETFs in those or mutual funds. They usually don't have those available as an investment option. So I think it does illustrate a mindset for people who are inclined to do that, again, set it and forget it process of investing. And there are pitfalls to target date funds. We could have a whole podcast on that. But I think net, I think it lends itself to being at least a decent default as an investor if you were otherwise indifferent.
Yeah, totally agree. We tell people all the time, if you want to be a do-it-yourself investor, we believe that's a pretty good place to be. So, Andy, there's another one that we see a lot where the gap is wider, and that's the return volatility. That's a fancy phrase for saying, it's all over the place. Maybe 20% one year, minus 20 the next. But maybe it's obvious to people as I say that why there's a gap. But can you elaborate on that? Why is there a gap on return volatility?
And I think what you're saying, Charlie, is the funds that are the most volatile, like you said, they ping pong the most, tend to have the biggest gap. And I think some of that is when you have a fund that returns well beyond the market, it gets attention. I think to ARC ETFs, in 2020, 2021, it's like everyone was talking about it because they were doing great.
Yeah.
And so when you get that attention, that's where you end up, you buy high, right? So it's like everyone's talking about it. You're on the golf course, you're in the cockpit, right? And you're having this conversation. You're like, oh, I got to get in on that. Well, it's like, the story has already happened.
People, Andy, sorry to interrupt you. People don't talk about money in the cockpit, though.
That's so I'm told.
Yeah, that's awesome, man. I love it. But yeah, so continue on. I interrupted you, but yeah, it's causing some bad behavior, right?
I think so. Yeah. And then of course it's more volatile. So it crashes, right?
Yeah.
And then you're like, oh my gosh, what am I doing in this thing? And it's time to sell. Time to sell. Absolutely.
It's amazing how that comes from investors picking their investments based on price alone. And you think about ARK as a perfect one. By the way, we've done podcasts on target dates and ARK, which are fascinating because nobody's going to buy ARK. And then, by the way, this was an ETF, Kathy Wood ETF on technology a few years ago, all the rage. But nobody buys it until the price goes up. Why wouldn't you buy it if the price is not up, right? And that kind of makes sense. But we've seen, like, for example, you and I and our firm, you're our chief investment officer, but we like small company investing. A certain slice of that we believe can provide diversification. But sometimes I've seen it in 401ks where let's say they remove a small company fund, and that's because it is more volatile. And the justification is the 401k committee says, hey, we had to remove that fund because when it went up, everybody jumped into it. And when it went down, everybody jumped out of it. So that 401k committee is responsible for, helping their, pilots in this case get good returns. And that was proving to not bear out. They were not getting the return of the investment itself. So they removed it altogether. And so that's another thing at target dates. They tend to not have those more volatile holdings as well.
Yep. So, absolutely.
Excellent. All right. Right on. Well, I want to jump into a couple specific things, like kind of more like, let's get specific. How does this happen? What are the ones that we really got to watch out for? And, you and I were doing our homework in it. And I think, what was the word we like to use? Was it, these are the core return killer biases.
There you go.
I could not use that phrase. I saw that. I was like, that's the return killer biases.
Yeah.
So that's
right. We have to use it.
That's what we're going to talk about now. Maybe that is a little bit hyperbole for sure. But let's talk about one of the number one influences. And that is what we've kind of been talking about. The dominant driver is poor timing of purchases and sells, buying after strong performance and selling after weak performance, which turns volatility, which should be good for a saver, into performance drag. Again, we're getting buying high and selling low. Andy, we talked about cognitive behavioral biases. There is a real bias of FOMO and it's a real psychological phenomenon. And I'll just read it here. You can Google that phenomenon, but it says it's characterized by anxiety, apprehension, and unease when individuals perceive others as having a more fulfilling experience or acquiring more valuable possessions. It is considered a cognitive bias because it systematically distorts judgment, leading people to prioritize perceived opportunities over their actual values or needs. Yeah. And so, that's pretty powerful. Warren Buffett said it best. This is envy. He said, envy of all the 7 deadly sins is the worst because you don't even get any enjoyment out of envy. The other sins you at least enjoy for a temporary, right? That was snarky, thought on envy.
Dang, Warren.
He's like, you at least enjoy the other ones. You don't even enjoy this one at all.
Yeah.
Makes you feel miserable. So what do you think? How can we prevent this? How do we prevent FOMO in investing?
Yeah, it's a good question. Yeah, sometimes herd mentality is what it's also associated with. I think it's contentment, Charlie. It's having a plan, knowing that you're on your own plan, you're on track, and you're doing the things you need to do to achieve your own goals. Because in the absence of a plan, then you're right. Then it is just I need is the highest performance possible for no other reason than to just have the highest performance possible. And of course, we like high returns. Of course, who wouldn't? But it can be detrimental to always be chasing those returns. Yeah, you nailed it. That's exactly right. You've got to be thoughtful about what's important to you, what your plan is, what you need to be successful. And so, that's awesome. Let's see. The second
Oh boy, I got to stay with our return killer biases. The second one
Yeah.
is
No
just
choice.
higher trading activity is associated with worse results. And again, funds with the most volatility show larger gaps than those with steady patient capital. I think here there's a little bit here going on too, the overconfidence bias. I know pilots are not overconfident, no way. And but it's
That's right.
it's so funny because I think there was a study that asked drivers, vehicle drivers, like, are you an average or above? Everybody was above average. Nobody was below
Yeah.
average or even
Not
average.
possible.
So we all
Right.
we all believe, and I think it's probably a good trait in the world of flying that you believe you're the man or the woman. But
Hmm.
overconfidence in the world of investing, which is a confidence cognitive bias, is going to skew your judgment to make you feel like you're really more capable than you are in this area, so that can be that can be difficult. It could hamper your returns, and it also is confusing to know in the world of investing when were you good or when were you lucky,
Yeah.
and so that's a
Yeah.
really hard thing to distinguish as well.
Yeah. And no one's bragging about their losses,
Hmm.
right? And when they talk about it, it's interesting. This along this point, the point Charlie just made of higher trading, more trading is the idea that exchange traded funds actually had wider gaps, and the paper attributed it to over trading, right? So, and it's kind of fun. One of my favorite things to do is just look at what are the ETFs that are out there, right? And there are some crazy ETFs,
Yeah,
Charlie, right? You can,
absolutely.
we were looking at some of
Let's
them as
let's
we
go
were
to
getting
that.
ready.
Yeah, those are good. We got to find those because I saw
Yeah,
that. I was like, we've got to make sure we include these before we run out
yeah,
of time because it's
yeah,
almost comical.
yeah.
So I'm scrolling down to find those now. But oh, here we
Yeah,
go.
yeah,
Inverse Kramer. What the heck?
love it. Jim Cramer, right? Mad Money. So the idea was, and I think it stopped trading. I was looking up the returns and like it was, it flatlined in 2024.
Yeah.
But it went against what Jim Cramer recommended on his Mad Money episode. It was the idea was, you could do better by doing the opposite
Mhm.
of Jim. So S Jim, I guess that's like Slim Jim. I don't know.
Mhm.
It is there, right? It's funny, the Wall Street Journal had an article in the business and finance section yesterday about ETFs, just how crazy they've become, and which I don't think was how it was originally intended, right? There
Mhm.
were some rule changes back in 2019. Before that, you could only be an indexed ETF unless you got this exemptive relief from directly from the SEC. They changed those rules so now everyone could really actively trade these exchange traded funds. And I don't have any beef with that, Charlie. Right? I think it's
Mhm.
fine. It's good to democratize investing, but I think the point is you can essentially buy anything, right? And now we have brokerage links and PCRAs, right? And so
Yeah.
you could even get outside of your, like you talk about the 401k with the 401k committee who gives you just a very limited menu option.
Mhm.
You can get outside of that and you could buy whatever you want. And you said earlier, is it hyperbolic? It may not be, right? Because we've
Mhm.
seen it where you can destroy like real wealth. You can do
Yeah.
detrimental, real harm. And so it's fun. I love talking about crazy ETFs, but in
Yeah.
the context of I just bought, Toke 10, this 10, which is ETF of marijuana stocks, appropriately named, of course.
Yeah.
I put 10% because I think marijuana, it's like that might not work out, or maybe it will, but it might not. And so I think that's the idea is we've had this ETF trading world has gotten
Yeah.
a little
Berserker.
banana.
Yeah.
Yes,
Yeah.
yeah, a little bananas.
Wow.
So the way I think about it, Charlie, is like, you are your own pension fund manager, right? And I think
Mhm.
about in the past, like, yeah, I grew up in Akron, Ohio, rubber capital of the world, no big
Nice.
deal, right? My grandparents, they all worked for Goodyear, Firestone, Bridgestone, and they had pensions, right? And it's like when you retired,
Mhm.
you got a pension. Well, that we all know, right? That's gone away. Now it's 401ks. And so the onus is really on you as the investor to be the prudent investor, right? And you think about
Mhm.
if a pension fund manager lost 50% of their pensions portfolio, you would be they would go to jail,
Mhm.
and you would be, I think, justifiably outraged. We should take that same approach, I think, as you're your investor, right? You're a pension fund manager, right? And the pension fund is you. And
Mhm.
And I think that, if you got to scratch that itch with your single stock ETFs, your Bitcoin, you can actually just buy the meme stocks. It's the ticker is meme.
Sounds like a winner. I'm going in.
That's a winner. I'm all in. You do that, but I think, yeah, like I said, you are your own pension fund.
Yeah.
At this point, the onus has been shifted, maybe unfairly so, onto the individual investor.
Yeah, you're right. And I'm joking, and I probably shouldn't even be joking about it. It's hard not to laugh at Toke and, a couple
Totally.
others. But
Yeah.
but it is man, it's so serious because we've seen it where people let their emotions, get involved, especially in difficult times like 2020. Man, these headlines are so crazy. There was a great article lately from my man Ben Carlson, and he just said I think the title of the article blog post is "What Didn't Happen." So check that out. Go to Ben Carlson, because you'll see all these crazy headlines, and if you believed them or if you took action on them, you would be in a world of hurt. The title of the article is "Some Things That Didn't Happen," and we've seen that. It's pretty rare. To see that from our perspective, because we're working with great people, but every once in a while we hear stories or whatever where people lose we're talking very significant amount of retirement, and it's not coming back if it's a real loss. And I think that's why our mission in this podcast is to cut through this noise, because there's a lot of noise out there that says you should do this, you should do that, and there's all these motives, and they're not in your best interest. And man, it takes a lot of diligence and caution to be your own pension fund. So I love that. You nailed it.
Yeah. Well, Charlie, one of the other things that came out of the study was active versus passive funds actually had similar performance gaps. In other words, you would think intuitively, if you're an active fund manager, meaning you've got an ETF or a mutual fund, they're trying to find the outperformers, you would think that would have a bigger gap than an index fund, which just tracks like the S&P 500 or the Russell 3000, US. But interestingly enough, they kind of didn't have a difference between active and passive. And so, Charlie, when I think about that, what that says to me is just because you're in an index fund doesn't mean you're a passive investor. Those are two very different things.
Absolutely.
So in other words, you could own the S&P 500 index fund, but if you buy and sell based on headlines and news, that fund, you're an active investor. So it's, I guess, maybe aviation, it's like flying IFR versus, or flying IMC versus flying IFR, right? Like there's a little bit of a difference, right?
I forgot what those mean. I forgot.
That's fine. I did too.
It's been a while.
Yeah.
Our audience knows. I'm just kidding.
That's right. Yeah, exactly. But I think that was interesting.
Yeah, that is fascinating, man. This is so valuable to everyone. And there's lots of people on the spectrum, from folks that are gambling away retirement monies. And, that's pretty rare, thankfully, but it does happen. But there are all of us, even when we go to make trades, Andy, you and I, and we're sitting there reviewing trades, and the market's down. It's like, ooh, man, or maybe there's one fund that's not performing like we wanted to, and we still are buying into it. Those are hard disciplines. And so those are the things I think about. But, Andy, are there any other biases or things that you're thinking about before we kind of put a bow on this, wrap up, as far as action items that people can take? Anything you're thinking about there?
No, I think we covered it.
Yeah, we did. I mean, as we go through this, I kind of been taking notes, and of course we've got all kinds of notes here on pre-study, but I just think about from the things we talk about today, I think firstly, you've got to be aware of what's going on. Awareness of our own cognitive biases. And let's just be honest, if you're a billion-dollar news agency or, YouTube entertainer, you are very aware of these cognitive biases. The algorithms, where you get your news source online are stacked against you. They're going to create this echo chamber of confirmation bias that says, I'm going to feed you news and information that you have clicked on before that's going to confirm your beliefs, whether they're right or wrong. So be aware of that stuff. I mean, you really got to be diligent. Some of the things we didn't talk to today, Andy, were kind of the habit patterns that you can have to set yourself up for success, whether that be automatic investing or, maybe even if you, like I've mentioned, we're conflicted here in this advice, but maybe even hiring someone is what you need to build that barrier in between you and your emotions. People do that, and it makes sense in cases. But any other habits that you're thinking about to help in this area?
No, I think that's right. I think we've done a podcast on should you hire a financial advisor, and that's I think that's worth thinking about. But I always think back to aviation. I'll try and do a better job on this aviation analogy than my last one. But, we say, at least in the Navy, right? You talk about situational awareness. Do you have a bad SA or do you have low SA? And being aware of it. Having low situational awareness, right? But being aware that you do is better than having bad situational awareness. And from like an investing perspective of trying to time the market, trying to not being aware of these biases that are maybe having you do these things that are actually headwinds against you. That's, bad SA. Yeah. And then, if you have, versus like a low SA, right? Or like, I'm just, I'm aware of these issues. How do we take advantage of them? And you're exactly right. Like put it in something that's low cost, diversified.
There you go.
You have an investment plan that you stick to, right? And some of that's just built in, our 401ks and the NEC that comes in, like that's a built-in investment plan. Yeah. But just being disciplined, I think, and then just knowing what your number is, what your plan is, I think is so helpful from an investment because it keeps you from chasing the next big thing.
Yes, you nailed it on the analogy this time, by the way. On the SA, I love it because I was told one time in a debrief, Charlie, you sucked the SA out of this portion. And so that's I always go back to that. It's always possible. So, but anyway, I love it. I love what you talked about, having the plan. There's no way you can get around, whether you do it yourself or hire somebody to do it. I don't think there's any way you can get around, doing this the right way without at least, I don't care if you put it on the back of a napkin at the bar or something, but some kind of plan. If you're married with your spouse, if you're not, this may be consulting a good friend, but a couple other little habits, and you nailed it. The discipline is huge. Getting that plan, sticking to the what you believe. A couple other little habits here is minimize your discretionary trading, focus on the long term, and the short term stuff can be scary. It can be distracting, and it may not even apply to you. And so now you're reacting to things that don't even apply to you. So be careful of that. Avoid chasing returns. Don't buy something just because the return's gone up, or don't sell it just because it's gone down. I mean, there's lots of other factors. Good investment, the price of a good investment will go down at some point, and doesn't mean you should sell it. So hopefully those things are helpful. But Andy, anything to add to that list that you're thinking about to help people?
No, I think it's a good study. Probably, we can put the paper in the show notes if folks are interested in reading it and taking a look at some of the shiny pictures. But I think and again, there's lots and lots of reasons, like we talked about, that the gaps may happen that aren't necessarily attributable to quote unquote poor investor decision. That's our point is not to just say that gap is for that reason alone. But again, all these things we've talked about, Charlie, and then we've brought up, I think are still valid points. And the number, I think, is directionally correct on why that gap exists, because again, some of these biases that we have as investors. And so I think just being aware of those is a good mental exercise to just say, what are my investing biases, or what are some things that I'm doing that maybe cause me to make decisions that are suboptimal.
Yeah. And potentially cost, some returns that's out there for you to have if you just kind of make sure you're doing the right things.
Yes.
So, awesome. Andy, thanks so much today, man. It was awesome. I hope it's helpful to our pilot audience. And if it was, please share it, share the podcast, rate and review wherever you get your podcast. We really appreciate that. It helps us reach more people. If you have any feedback for us, if it's good feedback, give me a call, Charlie. If it's bad, just call Andy and tell him. But we love feedback of any kind. We're open to it, ideas that you'd like us to cover. And we're coming up soon, Andy. We're going to go to the Women's Aviation Conference later in March. So we hope to see people there. Come by our booth, Pilot Money Guys, and then the Leading Edge, of course, booth will be there. And I'd love to see people and talk about what's going on out there. But thanks again, and we will see you next time. Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out, give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.